2 years of COVID-related disruptions and restrictions on mobility, the restaurant industry is poised for strong growth. As the operating conditions have normalized, people are going back to restaurants with full vengeance. In such a scenario, Speciality Restaurants, a leading fine dining restaurant operator, would benefit. Now, under the Moneycontrol Pro Discovery Series, we're looking at companies that are promising but not under our active coverage so far. And Speciality Restaurants is one such name. Building on the trend of higher delivery or takeaway mix, which has sustained even post-COVID-19, Speciality is scaling up its business via the low-capex cloud kitchen format. With cost control measures, it turned profitable last fiscal after a gap of 6 years. Now, we expect profitability improvement to sustain, which is a key re-rating trigger, and valuations provide further scope of re-rating from current levels. Post the end of COVID restrictions towards the end of FY22, the restaurant dine-in business picked up. Also, the start of offices and colleges aided recovery. Speciality Restaurants, which derives majority of its revenue from the dine-in segment, saw Q1 FY23 revenue reaching close to pre-COVID levels, which is Q1 of FY20. Its overall revenue in Q1 FY23 was 103% of Q1 FY20 levels. Now, apart from recovery in the dine-in segment, food delivery business is also gaining traction and is expected to sustain that momentum going forward. Speciality has scaled up the delivery takeaway business to 34% of revenue in FY22 compared to 8% prior to COVID. The company is setting up dedicated cloud kitchens for delivery orders. It has a cloud kitchen in practically every restaurant with a current count of about 60, and it aims to open another 25 to 30 outlets over the next 2 years. Cloud kitchens are smaller in size, typically about 500 to 600 square feet, and they require minimal investment of about 20 lakh rupees. Now, these cloud kitchens will help Speciality expand into new geographies and tap new consumers. Apart from the flagship mainland China food offerings, cloud kitchens also offer Hakka-style Chinese cuisine, which is essentially food items at lower price points, which has received encouraging response. Restaurant industry, particularly dine-in players like Speciality Restaurants, faced demand headwinds during COVID. Speciality took several cost reduction initiatives to improve its profitability. It closed about 20 unviable and high-cost mainland China restaurants. It also optimized manpower strength at both outlet as well as back-end operations and improved employee productivity through multi-skilling and multitasking. Furthermore, Speciality reduced restaurant space by about 30%, which significantly lowered overheads such as rental, power and fuel costs, etc. Negotiation of lease rentals, better vendor negotiations, and reduction in wastage also led to lower costs. The concept of cloud kitchens has also worked well for Speciality as they require much less space, staff, and have lower overhead costs. It has lowered its cost structure considerably and turned profitable in FY22 despite the revenue being significantly below pre-COVID levels. We believe the margin improvement is sustainable. In response to the encouraging demand, Speciality is ramping up confectioneries business under Sweet Bengal and Dariol brands. Most outlets are currently in Mumbai and it is expanding into adjacent regions such as Pune. Confectioneries business is relatively high margin business and Speciality has more than doubled its confectionery outlets over the last 5 years despite COVID-19 affecting operations, reaching a store count of 38 as of FY21. The company has maintained debt-free status over the past decade. Absence of leverage helped withstand the onslaught of the pandemic. In a high fixed cost industry like restaurants, maintaining a strong balance sheet is a key strength. Improving profitability and cash flows would fund the capex of the company going forward. It's also strengthening the management team. Second-generation promoter Avik Chatterjee, who is also the head of new business, is spearheading the new drink space formats such as Happy Pola and Episode. Speciality Restaurants can be compared to the likes of Barbecue Nation, which is a casual dine-in restaurant operator. While Speciality has lower scale, both companies' operating margins are comparable. Speciality Restaurants posted a profit at the net level in FY22 compared to a mild loss posted by Barbecue Nation. Both have a strong balance sheet and are almost debt-free. Now, if you look at the stock, at the current market price, it's trading at an EV to EBITDA of 9 times its FY23 projected earnings. Valuations are at a 15 to 20% discount to Barbecue Nation on both EV to EBITDA as well as EV to sales basis for FY22. Even on trailing basis, Speciality is trading at a 30 to 35% discount compared to a Barbecue Nation.